everyone, my name is Amin Reina and I'm an investment coach and founder of Sage Investors, and I'm here to get you in the loop about what's going on in the market, about all things investing. So what's going on in the markets right now? Well, there seems to be a big push into the commodity space. A lot of inflows into commodity-based stocks and ETFs have been flowing quite heavily in the last few months. It's interesting because also a lot of the smart money people are out there are starting to pound the table that we are on the verge of a super commodity cycle like we were in the early 2000s. So, which is kind of interesting because if you look at some of the stocks of commodity-based companies, if you look at stocks like Nutrien, which is in the agriculture basis, this is a stock a year ago that was in the 30s, that's now in the 70s, that's like now in the low 70s. Copper is a big thing right now. And if you look at copper prices, and especially the copper stocks like Southern Copper Company, is a stock that was trading in around the 26 level a year ago in the depths, as we were like in the depths of this pandemic meltdown. And it's now like a $70 stock. Oil, which was literally like negative last year, a negative price last year, is now trading at about $60 a barrel. Oil stocks have come with it. Companies like Canadian Natural Resources, which were like $13, are now like $33. So it's kind of funny, like all the smart money people are pounding the table for a commodity super cycle, but if you look at the stock prices, they clearly have priced that in. It's been a lot of low-hanging fruit. So what does that mean going forward? Like I'm trying to figure out, well, how does this mean going, what does this mean going forward? Well, let's figure out what drives commodity prices. If you look at what's been happening over the last year, it's one of the key factors that you got to look at is the relationship between real interest rates and commodity prices. There's a bit of an inverse relationship in that real interest rates, and when we're talking about real interest rates, it's basically taking the nominal interest rate and deducting or subtracting inflation, and that's what's left over is essentially like your purchasing power. And if you look at real rates over the last year, they have been falling quite steadily, and the logic being, as real rates fall, that usually is an inverse relationship and will have positive impacts in terms of commodity prices. What's the logic? What the logic is, inflation is going up, so which is bringing real rates down. It's putting pressure on currencies like the US dollar. The US dollar has been also going down, which is also another trigger for an inverse relationship with commodity prices. What's happening? Well, as your cash, as your paper money loses that purchasing power, the concept of holding paper type assets becomes less appealing because, you know, you're getting paid basically nothing to own bonds or any other kind of paper-based asset. So what's the move? You go toward hard-based assets. You're looking at commodities, you're owning land, real estate. And now we've got this new player, which is digital currencies. That's the play. So that's the logic right now, and that's been the trend. Real rates have been falling and commodity prices have been inversely rising. But what's happening now? Now we're seeing a dynamic where interest rates are starting to track up. The 10-year yield is now over 1.3. A year ago, it was like near 0.5. Five-year bonds, 2-year yields. I'm talking U.S. Treasury. You can talk about any Canadian stuff also across the board. They're tracking up. 5-year Canadian bond now is 0.6. It was like 0.35, like literally 6 months ago. The trend right now is for real rates. It looks like real rates are starting to now creep up. So what does that mean? Play the mind map game. So if that means the case, that means we're looking at a potential where currency prices could be going up, like the US dollar might be starting to get more appreciative cash might be more appealing to hold. The purchasing power might start to increase. And what that means is that the incentive at that point, if real rates were now to start to creep up, would be less to hold commodities and land and digital digital assets with rising real rates. So that's the trend right now, and that's the play right now, and that's the tension right now, is where are real rates going to go? Well, we're getting some signals because the Federal Reserve came out yesterday basically saying they're going to keep rates low. Basically, that's kind of what they said in a nutshell. And they're willing to let inflation run a little bit higher than they normally would be comfortable, because their mindset is the economy in the US, globally, is scarred, is hurt, it's been torched, it's going to take a long time to recover. That's their mindset. And so if that's the case, and at the end of the day, we don't want to fight the Fed. That's one of the rules. We don't want to fight the Fed. If that's what their mindset is, then maybe we're going to see real rates maybe start to creep back down right now. But then we have the bond market, which is basically pounding the table for increased interest rates because they're saying, you know what, we've got vaccines. We're seeing recovery. We're seeing a recovery now in growth from the bottoms of last year. We think rates are primed to go up. So this is the tension right now. And so, but at the end of the day, where we want to see that tension is going to get fought out is going to be in real interest rates. So that's kind of where I'm looking at right now. And that's kind of where I want to pay our attention. If we want to determine where we're going with respect to commodities, I think at the end of the day, we're going to get another bump up in commodity prices because the reality is supply chains around the world are going to start to get localized. That's going to be inflationary. A lot of investment, a lot of stimulus money is going out in the world. It's going to be done to reinvent a lot of things because of COVID. That's going to put up we're going to have to get used to the concept of higher prices. And if we're going to have higher prices, that's going to feed ultimately into commodity prices. So in the short term, medium term, we could see a pullback if real rates start to creep up. But if the long-term trend is for real rates to keep going down and lower with all the money sloshing around and with central banks wanting to slosh money around, we could see a nice little run up in the medium to long term in commodity prices, and ultimately commodity stocks and ETFs may be something to look at. So that's kind of the game right now, and that's the mindset right now. Let's see how it shakes out. So that's all I got for you today. If you want to follow any more of my videos or podcasts or anything else I talk about in terms of all things investing, you can follow me on Twitter. My handle is @SageInvestors. You can also, if you're interested in any of the online investing courses and in-person real-time investing courses that I do teach, you can find out some more information through my website, www.sageinvestors.ca. That's all I got for you. It's been another edition of In the Loop. My name is Amin Reina, again, of Sage Investors. Good luck, do your homework, stay safe, and we'll see you next time. Cheers.